In the wake of recent record high metals prices, the Chinese authorities have warned commodity companies about pushing prices up too far. What's going on and why? And where's it all going to end? John Meyer joins us now from SP Angel. John, good to talk to you. What's happening in the markets at the moment? It's quite a difficult story if you believe that the markets set their own prices. How can China get involved in pricing?
China would love to control pricing, but I think what they recognize is that controlling global prices for commodities is extremely difficult, if not impossible. There was the threat a few weeks ago that they would actually set a domestic price for copper. In fact, if anything, I think it's the price of iron ore that has been concerning them much more than the price of copper. Although copper is more generally used by manufacturers in China, the stimulus projects that the Chinese have been working on have sucked in so much iron ore, they've driven the price up to over $200 a ton, which let's face it, is a crazy price for a commodity that costs about $15 to $20 a ton to produce in Western Australia. So China is desperate to reduce speculation. They can't blame it on Western speculations because most of that speculative activity is actually happening in China. So what they're doing is nudging prices down by pulling the various levers that they do, by slowing the stimulus programs to some degree, and just by making threats to the marketplace.
Why are they doing this? What is it that's generating this sort of this intervention by the authorities?
Well, they're worried about inflation. I mean, they're particularly worried about food inflation, but they're also worried about the effects of inflation hitting particularly smaller manufacturers where margins are much lower. And remember that logistics costs, transport costs have gone up a lot recently. So the cost of exporting containers to the West has at least trebled. And so they've got to cope with that. And they know that if prices go up, then that inflation is very dangerous for their economy. So they see the main danger as price rises being driven by underlying commodity prices, even though the cost of a commodity is often under 5% of the cost of the finished goods. Everybody sees a rise in commodity price as a reason to push up prices anyway. Now, if we look at steel as an example, the cost of steel rebar, for example, rose from $660 to $800 a ton this year. And that was driven by iron ore prices rising from $156 a ton to over $200 a ton. So it does have this inflationary aspect to it, particularly in the steel industry, and that is costing the Chinese economy and the Chinese government a lot of money in terms of the stimulus that it's been putting into these projects.
One can't help but think perhaps maybe the West is looking at this thinking, well, actually, China's actually doing quite a good job because the West doesn't like the potential inflation that this rise in raw materials prices is likely to bring. And I know that the Fed's talking about possibly a transitory effect of all this in terms of on inflation. And we are hearing from some central banks, of course, that they don't intend moving interest rates up, believing it to be transitory. But in terms of the overall move in the market, I mean, let's just take a look, if we can, at what's happening, for example, here on the price of iron ore. It has risen, as you say, substantially. It went up to the record highs, pulled back. Copper hasn't pulled back quite as much, but it clearly is having or likely to have an impact. But when you do, as you say, nudge prices, albeit by a small amount, is this not just going to delay any further upside? The upside still likely to come, presumably, because we've been talking in the past about the fact that you've got the situation where China is having all this demand and it's demanding a metal that is not being supplied to the market. Ultimately, prices presumably will have to rise at some point. This is just a delaying tactic, isn't it?
I think you're right. I think ultimately this does just delay the inevitable. I think countries and governments are going to struggle unless they get truly draconian to hold back higher commodity prices, which, let's face it, have been relatively low for many, many years. But they are concerned, particularly about copper pricing, of the inflationary impact. I'm not convinced that Western governments are that worried about the inflation. I think, in fact, if anything, they see the inflation as good, as useful for inflating away the debt that governments have been incurring. What they want to do is manage that inflation so it doesn't get out of hand. Nobody wants to see another Weimar Republic. We don't want European nations suffering in the way that Zimbabwe has done with hyperinflation, and everybody's concerned about that.
But at the same time, there's a bit of King Canute about this, isn't it? You can't hold it back forever. But the other point I would make is the fact that if you do see, like we've seen, this big drop in the price of iron ore, for example, if you do get a continuation of the drawdown we've seen in terms of pricing, you then start to price out some of these producers, don't you? Because it's becoming more and more difficult, one, to find the metal in the first place, and then you've got to go through the process of building your mine. And the cost of getting out of the ground is so much more now than it was 10 or 20 years ago, because the easy copper or iron or whatever has been taken out of the ground. They've got to have this high pricing in order to be able to pay the staff to get it out of the ground, to get it to the manufacturers, surely.
Well, I think in iron ore, there's such a huge differential in pricing that I don't see a problem there. Although for local Chinese iron ore mines, the high price is very important because their costs are high and the quality of their iron ore is very poor. Although the high pricing has been drawing in the better quality iron ore from Australia, so it's a different matter. But China's been just touching the brakes a little bit in terms of spending for stimulus. And it's got a very good idea of what's going on with all those stimulus projects, because it monitors the activity of about 600,000 pieces of construction machinery, from excavators to machines that pour concrete to machines that like cranes and other lifting machines on these building sites. And they can actually see that many of those building sites are maturing from the early stage now to the later stages of where they're fitting the equipment into these buildings. We're talking door handles, bathroom fittings, kitchens, and then painting those apartments as well. So the mix of commodities they are drawing into China is beginning to change. And okay, China has a steady program where they can continue to start up new projects. But what I think they're doing is delaying some of the new projects. And so it's quite likely that we might start to see iron ore demand into China starting to fall, but demand for other products, copper, as you've mentioned, nickel, zinc, other metals, rare earths, those sorts of things, all continuing to rise. And let's not forget there's so much stimulus going into wind farms, solar farms, and electric vehicles, that the mix of commodities that the world is using is changing.
We've spoken before about how to make money out of these markets. Does what we've been talking about today change any of that, do you think? I mean, how do we go about making money out of the markets as they are at the moment?
Well, yes. I mean, when it comes to mining companies, you start to look at those companies that are producing rare earths, producing copper, producing zinc, tin, nickel, the metals that are used in the later stages of the developments of these construction projects. And there are tens of thousands of these projects in China, and many, many more that are actually getting going in the States, which is probably a year, 18 months behind the stimulus programs that we've seen in China. China was absolutely ready on the button to get those projects up and running. The US is a year behind, shall we say, and Europe, I suspect, will be 2 to 3 years behind.
Okay, all right. John will leave it there, but thanks for joining us. John Meyer from SP Angel with his view of the recent pricing of raw materials and the Chinese involvement. For more videos like these, follow us on Twitter and Instagram and subscribe to our YouTube channel.